despite the very small rise in gold, which is about 1% or something like that, GDX and GDXJ, these are the indexes, the ETFs, which track the gold mining shares, rose. They took a very large jump, something like 5% in the first day or two of this year. So it could well be that portfolio managers now starting a new year are saying, what can I put in my portfolio which might have a good performance? So then if you put year to date, there you are. It's like, what's it say, 2.46 on the, which currency is that? It's USD.
Yeah.
So it's had these ETFs have had a much larger jump than the gold price itself. And I think maybe portfolio managers are starting to put a little bit of gold mining shares into the portfolios.
At the start of the year, gold mining ETFs like GDX and GDXJ saw a significant rise of around 5%, outpacing gold's modest 1% increase. This suggests that portfolio managers, beginning a new year, might be allocating to gold mining shares, anticipating strong performance and diversifying their portfolios. This trend highlights the growing interest in mining equities as a strategic investment. The speaker, Clive Thompson, a renowned journalist, author, and technology commentator, explains that banks maintain reserves at central banks to ensure they can meet depositors' cash demands, especially during high-demand periods like holidays. These reserves allow banks to access funds overnight to cover withdrawals without needing to call in loans. If reserves fall too low, banks face increased risk during a crisis or bank run, as they may not have immediate access to funds. In such cases, banks would need to negotiate with the central bank to exchange assets like mortgages or loans for cash, a more complex and uncertain process than simply withdrawing their reserves. Clive Thompson highlights that the U.S. government has reached a new debt ceiling, which limits its ability to borrow beyond the current debt level until Congress approves an increase. Although the Treasury can continue operations for about 14 days using funds from recent tax inflows, it will soon need to implement emergency measures. These measures typically include using cash balances, reducing funds in other agencies, and borrowing from government pension funds with a promise to repay them once the debt ceiling is raised. Clive points out that debt ceiling negotiations, often prolonged, are expected to begin soon. Historically, these debates have caused delays and uncertainty, but emergency measures have ensured the government continues to meet its obligations temporarily. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
The reason banks keep reserves at the central bank is in case their depositors come for cash. So let's say it's Christmas or whatever it happens to be, and all the depositors turn up on the same day because they want to go Christmas shopping, want to draw the cash. You can't call in the loans that you've lent to corporations or to the credit card companies or to the private individuals because they can't repay. So you have reserves at the central bank, which you can call on literally overnight. You can say, the central bank, send me back $1 billion or send me back 100 million, whatever it happens to be, and they'll send it to you. And that way you always have enough on hand to pay out the depositors. So what's this potentially showing? It's either showing that the banks don't think their depositors are going to come calling for the cash, or maybe it shows that the depositors have already come calling for the cash and they don't have too many reserves left. But the problem would be, if those reserves drop too low, there's less ability for the banks to handle a crisis when there's a run on the bank and people say, I'd like my money out, because they can't then immediately go to the central bank and say, give us our reserves back. They have to strike a deal with the Federal Reserve saying, please, would you take something else off us, like mortgages or loans or commercial loans or something, and then it's down to the Federal Reserve to agree with that and lend them the money, which obviously is a different kettle of fish than taking your own money. First of all, we've gone into the debt ceiling yesterday, so we have a new debt ceiling. It doesn't mean to say the Treasury can't keep borrowing, because they've had a large tax or refund from one of the funds, the social benefit funds, which means they can keep going for another 14 days before they have to start doing what's called emergency measures. So what does the debt ceiling mean? It means that the US government is not permitted to borrow any more money than the current level of debt until such time as they raise the debt ceiling. Now, there's a discussion going on to see whether they can actually get rid of that debt ceiling completely. But every year or so, every 2 years, they have this new debt ceiling, which they're not supposed to pass. And here they are. They put this new debt ceiling. It was something which was agreed about a year and a half ago. They agreed that the level of debt at the 2nd of January 2025 would be the absolute level of debt allowed until they agree a higher ceiling. So now the negotiations are going to start. Those negotiations might, if history is any guide, those negotiations about the new debt ceiling might continue for many months. But in 14 days, they'll hit that debt ceiling, and Mrs. Yellen will have to start carrying out emergency measures, emergency procedures. She hasn't specified what that actually means, but if we look at the history, it basically means they'll run down balances in other agencies, they'll use up the remaining cash balance, and then they'll start resorting to raiding the government pension funds. Now, when they've done this in the past, they've always said, we don't have any money to rely on, but we have to keep paying our bills, so we're going to borrow or force the pension funds, these are the government pension funds, to give us the money, and then once we get the debt ceiling raised, we'll refund the pension funds in full with interest. That's what they said, and I assume that's what they did last time.
In his recent interview with Mario Ineco, Clive Thompson exposes that if the debt ceiling is raised, the U.S. Treasury will need to borrow heavily to replenish its funds, creating significant pressure to sell Treasury securities. The success of this depends on investor demand at current interest rates. If demand is insufficient, interest rates could rise, potentially reaching levels around 5.5% to 6%. That may cause concern or even panic. In such a scenario, the Treasury might rely on the Federal Reserve to purchase government bonds, similar to actions taken during the global financial crisis and the pandemic. This would require the Fed to create electronic money, expanding its balance sheet to support the government's spending needs. Clive explains that signs of strain are emerging in the euro system, reflected in diverging interest rates on European government bonds. Countries like France, Germany, Italy, and Spain, which share the euro, are seeing their bond yields differ significantly. For example, French bonds now yield about 1% more than German bonds of the same maturity, indicating varying levels of perceived risk. This trend is reminiscent of the financial crisis when interest rates in countries like Portugal, Italy, Greece, Spain, and Ireland diverged due to fears of potential defaults. Although rates have since converged, the recent divergence suggests growing concerns about repayment risks among Eurozone countries. This signals potential instability within the shared currency system. Now, let's shift our attention towards the interview.
There are signs of strain in the euro system. That's the euro as a currency. And we're seeing that because the interest rates on European government bonds, I'm talking about France, Germany, Italy, Spain, and so on, are diverging. Now, when the euro came into existence, all the interest rates on 10-year bonds or 3-year bonds or 5-year bonds started to converge. Yeah. Then we had, they became roughly the same. Then we had the financial crisis. So there was 4 or 5 years from 2008 onwards when the interest rates diverged, and then they started, particularly because countries like Portugal, Italy, Greece, Spain, Ireland were potentially going to default. And that was a big worry at the time. So the interest rates on those types of bonds started to diverge again. And now they've come back together, or did come back together. But we've seen in the last year or so that these interest rates are once again starting to diverge. It's indicative that there might be some sort of crisis brewing. The interest rate, I haven't got in my head, but I think on French bonds, there's something like 1% higher than German bonds of the same maturity. Now, they're both in the same currency. They're both supposed to be core members of the European Union, yet you have very different interest rates. Now, if the risk was exactly the same, you could borrow euros at the German central bank rate and deposit them on a 10-year French bond and make a 1% difference every year. And then you leverage it 100 times, you're making 100% a year. Now, that's obviously ridiculous and nobody's really doing that. But if you do that sort of deal, you're obviously taking the assumption that the risk of the two is the same, but clearly it's not, and that's not what the market thinks. The market thinks that the interest rate is telling us a story that the chance of you getting repaid from some European countries is considerably less than from others now.
Yeah, and you can see here what Clive was talking about. You see the Greek bonds, they were yielding like almost 8% when the euro kicked off in the late 90s. and then it converged. They all converged, and they did really well, in terms of converging. And then they all went up together during in the late stages of the housing or mortgage-backed security boom, and then they all went down. But then they started diverging here. This is where that European sovereign debt crisis was. And I remember the 10-year Greek bond went up over 40%. And it doesn't show it here, but so what Clive is saying, we're starting to see a little bit of that, right? And that's really a danger to the euro.
The discussed financial dynamics underscore the interconnectedness and vulnerabilities of global markets, from the U.S. debt ceiling and Federal Reserve interventions to strains in the Eurozone bond market. These developments highlight the delicate balance central banks and governments must maintain to ensure market stability, investor confidence, and economic resilience in the face of growing debt and systemic risks. How might rising interest rates in the U.S. impact global investor demand for Treasury securities? What measures can the Eurozone implement to address the growing divergence in bond yields and maintain confidence in the shared currency system? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.